in today's market. You see names like PayPal and Shopify, some of the under the big mega caps, but those big tech names are just getting killed.
And not just that. And, you know, a lot of traders like to look at some of the statistics around trading activity. And one of the things they look at are certain gauges of momentum or relative strength or some other measure thereabouts. If you look at the S&P 500 overall, some of the stocks that are now trading the most below their longer-term trends, in this case, we're looking at those stocks that are the most below their 200-day average price on a rolling basis. You're talking names, and I believe at one point yesterday, the biggest downside move below its 200-day average price or longer-term trend, guys, has been Netflix within the S&P 500. Mm-hmm. You have to put PayPal in there as well, to your point, Deirdre. Also, Etsy is in that mix as well. So many of these names are now trading at levels where you think to yourselves, maybe there is a bounce out there, but this has now become very much a momentum trade. And the trend has been the friend to the downside for a lot of the bears out there. It's going to take a little bit more, I guess, evidence for those bears to reverse course and say maybe things are bottoming out as we speak.
Yeah, Dom, we'll see. Thank you. And we're going to stick with stocks, talk some individual stocks. Twitter, for one. Julia, you're looking at how Elon Musk's buyout could impact the larger digital ad ecosystem. What do you think?
Well, John, I first think we have to ask how the timing of this buyout and the fact that the board accepted this offer just a couple of days before Twitter's earnings could indicate broader concerns for the ad-supported space. I mean, we saw some of these issues raised in Snap's earnings. They mentioned they've seen advertisers pull back both because of supply chain constraints, also the impact of inflation. And I think this could indicate that Twitter's numbers could be quite bad when they report on Thursday. And it could also mean that we're seeing those broader challenges front and center for the likes of Meta, as well as Pinterest and even Alphabet, which reports today. So I think that's the question, sort of how bad is the ad environment that the Twitter board was in a rush to accept this deal before earnings. And then I think there's this broader question of if Musk does get rid of content moderation, if maybe the content on Twitter becomes more risky for brands, are we going to see advertisers shift ad dollars away from Twitter and into the likes of Meta or YouTube or Snap or even TikTok because that platform becomes a little bit more risky to them?
Twitter not exactly a bellwether, though. I mean, when you look at all of the social networks out there, it's kind of like it's a scrub, revenue-wise. So even if Twitter's business were to, if all of Twitter's business were to go to Meta, that would be a nice little one-time bump maybe, but it would still be a little one.
Yeah, a little bump. But I think the question is, where do these dollars move? Twitter is 85% brand advertising. So that's the type of advertising that typically is more similar to TV advertising rather than direct response, which is what Facebook is particularly good at. And so there's also been some speculation by analysts that we would see those ad dollars, $5 billion a year. So it's not nothing, but it's not at the size of a Meta that could shift over to the likes of Hulu or Peacock or Pluto, these targeted digital video ad platforms, and they could benefit from some of that money moving around. But we'll see. And we'll also see maybe Elon Musk has a way to make advertising even more beneficial, even though he's certainly been very critical of the ad-supported business as a business model for Twitter.
All right, Julia, thanks.